Welcome to Investor Web, your reliable channel for all things investment. Our mission is to simplify the investment maze, breaking it down into digestible bits for everyone. Whether you're a long-time player in the finance game or just taking your first steps into this intriguing world, we are here to provide insightful, practical, and actionable investment advice, making the complex world of finance accessible to all. Our content covers a broad spectrum from market trends and financial news to tips and strategies, all aimed at helping you make informed decisions about your financial future. We believe that everyone should have the tools they need to build a strong, diverse portfolio. So if you're ready to take control of your financial destiny, you're in the right place. Today, we delve into the 5 types of stocks you should consider adding to your portfolio. First on our list are the blue chip stocks. These are the heavyweights of the stock market world, the titans of industry that have stood the test of time. They're the mature, established companies that have been around for decades and have a track record of stability and reliability. Blue chip stocks are often leaders in their respective industries, boasting a national or even international presence. These are companies with a market capitalization in the billions, and they're recognized by their strong financial performance, robust management, and ability to generate profits, even during economic downturns. One of the primary characteristics of blue chip stocks is their tendency to pay regular dividends. These dividends are a portion of a company's profits that are distributed to its shareholders, providing a consistent income stream in addition to any potential capital gains. This makes blue chip stocks particularly attractive to income-focused investors such as retirees. Another major draw of blue chip stocks is their stability. While they may not offer the sky-high growth potential of some smaller, more speculative companies, they also don't come with the same level of risk. This makes them a good choice for conservative investors who prioritize preserving their capital over chasing potentially higher returns. Examples of blue chip stocks are plentiful. Think of companies like Microsoft, Johnson & Johnson, or Procter & Gamble. These are companies that have been around for a long time and have a reputation for quality and reliability. They're the kind of companies that people tend to stick with, even in challenging economic times. So why should blue chip stocks be a part of your portfolio? Well, they offer a combination of stability, regular income, and steady growth that's hard to beat. They're a good way to diversify your portfolio, reducing risk while still offering a decent return on investment. And in a world that's full of uncertainty, there's something to be said for the peace of mind that comes with investing in a company that's been around for a while and is likely to be around for a while longer. Blue chip stocks, a stable and reliable choice for any investor. Scene script. Next, we explore the exciting world of growth stocks. These are the shares of companies that are expected to grow at an above-average rate compared to other businesses in the market. They're the young upstarts, the innovative disruptors, the companies that are breaking new ground and making waves in their industries. Growth stocks are often found in tech, biotech, and similar sectors where rapid innovation is the norm. Now, why are growth stocks attractive? The answer is simple: their potential for high returns. When a company grows, its revenues increase, and typically, so does its stock price. If you've chosen wisely, you could find your investment multiplying in value. Imagine being an early investor in a company like Amazon or Netflix. The returns would have been mind-boggling. However, as enticing as the potential profits from growth stocks are, it's critical to remember the risks. Growth stocks can offer high returns, but they also come with significant risks. These companies are often in the early stages of their business cycle, which means they may not yet be profitable. They may be investing heavily in their growth, which can lead to volatility in their stock price. Moreover, growth stocks are often priced based on future expectations. If a company fails to meet these expectations, its stock price can take a hit, and sometimes growth stocks can be overvalued, leading to a bubble that can burst. But let's not forget, no risk, no reward, right? And the rewards can be substantial. Companies like Apple, Google, and Tesla were once considered growth stocks. Early investors in these companies have seen their investments grow exponentially. To summarize, growth stocks are shares in companies expected to grow significantly faster than the market average. They offer the potential for high returns, but also come with higher risk. Therefore, they can be a valuable addition to your portfolio if you're willing to take on a bit of risk and have the patience to wait for the company to grow. Growth stocks, a high-risk, high-reward addition to your portfolio. Moving on to a favorite among investors, dividend stocks. These are the stocks that belong to companies which, in addition to offering potential capital gains, also pay a portion of their earnings back to shareholders in the form of dividends. Now, why is this enticing? Well, dividends provide a steady stream of income, which can be especially appealing in uncertain market conditions. So let's delve a bit deeper into the benefits of dividend stocks. First up, they offer a steady income stream. This is particularly appealing to investors who rely on their investment income for living expenses. This could be retirees or those who prefer a more conservative investment approach. Secondly, dividend stocks can offer a cushion in volatile market conditions. You see, when stock prices fall, dividends can help offset some of these losses. Thirdly, companies that pay dividends are often more established and financially stable. They've been around the block a few times, so to speak. They have consistent earnings, a strong market presence, and they're not going anywhere anytime soon. Now, you might be wondering, all right, this sounds great, but what are some examples of dividend stocks? Well, let's take a look. Blue chip companies such as Procter & Gamble or Johnson & Johnson are often reliable dividend payers. These companies have been around for a long time, they have a solid history of profitability, and they consistently pay dividends to their shareholders. Another example could be utility companies. These are often considered as defensive stocks, as people will always need utilities regardless of the economic climate. Companies like Duke Energy or Southern Company are known for their consistent dividend payments. In conclusion, dividend stocks can be a valuable component of your investment portfolio. They can provide a steady income stream, offer some protection in volatile markets, and come from companies that have a track record of stability and consistency. So, if you're looking for an investment that can generate consistent income, dividend stocks might just be the ticket. Dividend stocks, a consistent income generator for your portfolio. Now let's turn our attention to value stocks. Value stocks are akin to hidden gems in the vast diamond mine that is the stock market. They are shares of companies that are considered undervalued compared to their intrinsic value. In simpler terms, these are stocks that are trading for less than what they are actually worth. This discrepancy often arises due to market overreactions or overlooked potential. Value stocks have certain distinctive characteristics. They often have lower price to earnings, PE ratios, and may pay dividends, which we discussed in the previous scene. These stocks are usually associated with mature companies that have stable but slow growth rates. The appeal of value stocks lies in their potential for significant price appreciation. When the market eventually recognizes the company's true value, the price of the stock can surge. Moreover, because these stocks are often undervalued, they provide some level of protection against market downturns. They're like a safety net, offering a degree of resilience during economic downturns. Let's consider a hypothetical example. Imagine a company, let's call it Company A. This company has a robust business model, steady revenue streams, and strong future prospects. However, due to a temporary setback, such as an earnings miss, the market overreacts and the stock price dips. This dip, my friends, represents a potential value stock opportunity. Investors who identify this and invest at the lower price point could see substantial returns when the market corrects itself and the stock price rebounds. Incorporating value stocks into your portfolio can add a layer of safety and offer potential for high returns. They allow investors to buy shares in worthwhile companies at discounted prices. It's like finding designer items at thrift store prices. However, it's essential to remember that value investing requires patience and thorough analysis. It's about playing the long game, waiting for the market to recognize the true value of the stocks. Value stocks, a bargain buy for the discerning investor. To wrap up, we've explored the 5 types of stocks to consider for your portfolio. First, we delved into blue chip stocks, the stalwarts of the market that offer solidity and long-term reliability. We then moved on to growth stocks, those exciting prospects that promise rapid expansion and potentially high returns. Our journey continued with dividend stocks, a great way to earn a steady income stream while you wait for your investment to appreciate. After that, we discussed value stocks. the hidden gems that are often undervalued by the market but hold great potential for growth. Each of these stock types carries its own risks and rewards, and the ideal mix for your portfolio depends on your individual financial goals, risk tolerance, and investment horizon. Diversification across these categories can help you navigate market volatility and achieve a balanced investment strategy. Remember to subscribe to InvestorWeb for more insightful investment advice. Happy investing!